everybody. Guess I should bring the microphone over here so y'all can hear me. Good morning, everybody. Hopefully y'all are having a great Friday. So this morning we are selling off a little bit more than we did yesterday. Let me get rid of all these tabs that I've got open. Jesus Christ, I'm a mess. Currently in the process of editing, hence why I have a million tabs open. But so the Adobe spread that I had opened actually went against me. Adobe had a pretty good earnings report at $3.50 earnings per share. The estimated was $3.40 earnings per share. Something interesting about Adobe earnings and a lot of tech earnings is that they're using share buybacks and they're using employee stock compensation to make their earnings per share look better. So this is GAAP versus non-GAAP earnings. So we can talk about that a little bit before the trading day starts. Let's see. Oh, please do not say that I don't have internet. Investor relations. So if we go to their SEC reports, the bell just rang. Let's see where we're trading. 344 for Adobe. SPY's trading at 385. So it did end up bouncing a little bit. And then I also have a TLT trade that's open currently that I'm looking to take profits on. Looks like TLT is really selling off this morning, which is a little bit surprising given that the markets seemingly are selling off based on recession fears. Usually bonds do better during recessions, but that's not what we're seeing with TLT. But let's go over to their Adobe's earnings. Let's see if we can find the damn thing. The press release. You could also find this on the SEC report, but every time I go to sec.report, I always get, I can't ever pull up the actual PDF file. Really annoying. But if we look at their earnings per share, their GAAP earnings per share, it was $2.60 to $2.65. Oh, sorry, this is actually forward-looking for their next quarter. I don't know why they would put that as their first note, but let's see. Should be right here. Net income per share was $2.53, and then their non-GAAP earnings came out to $3.60. So what you do in order to find the discrepancy here is you go to, I believe it's either in the cash flows. Let's see. I'll search for employee stock-based compensation usually is what they'll list it as. No. Maybe buybacks. No. Interesting. They're supposed to give basically the synopsis on the difference between their GAAP and non-GAAP, but I forget which part of the statement that it's in. Don't want to spend too much time on it, though. Basically, the difference between GAAP and non-GAAP is that they can include share buybacks and employee stock compensation. They write that off, basically, for usually tax purposes, and that gets reduced, or I guess improves their earnings per share. Thank you for liking the video, Martin. Got 4 likes and 30 viewers. I think we can get more. But let's head on over to the charts. SPY is currently trading at 386, so we are recovering. I didn't think that we would sell off as bad as we were down to 382. I would be opening a put credit spread, but I'm actually barred from trading today. Interesting enough. So I actually got assigned early on a spread. So this is not the page that I want, but my account's at a deficit, will be resolved by the end of the trading day. Until my deficit is resolved, I can't open any new positions. So basically what happened is somebody assigned a SPY put that I had, or I guess a SPY call that I had open. I think it was a 345 call. So it was super deep in the money. basically has zero extrinsic value, and whenever there's zero extrinsic value for the option, it's all intrinsic value. So that's the best time for somebody to exercise that option. So they decided to exercise about 24 hours early, which put my account in a deficit because Robinhood ended up exercising the option that I had bought for the spread on my behalf. So now, can't make any new trades on the Robinhood account. So, sucks, but at least we have some open trades, and you can close open trades. Luckily enough, that would suck if they locked you from that. But this 109, 110 call credit spread that I have for TLT is doing pretty well so far. So I'm up $178. I originally opened it at 30 a piece. And if we look at the TLT, it's currently trading at 106.50. So the odds of coming all the way back to 109, which is where it was at the height of yesterday, extremely low. The only thing that would maybe cause that to happen would be potentially either more spread of recession fears, like amplified spread if something really bad happened, or like, I don't know, Robinhood going bankrupt or something, or if something like more war escalation happened. That's when you would see TLT. GLD would probably move up with it. Gold tends to outperform during times of recession as well. And then bonds generally outperform. But let's see. So we have SPY trading at 386 right now. So if I was able to make any trades right now, I would probably be opening a put credit spread. I think the sell-off in the pre-market was a bit overdone. And if I had to choose a price, I would probably say the 384. I'd probably want to close if it goes below this candle of significance. So you take the open, which was 383.94. The close was at 385, so about a $1 difference. So I'd probably close if it comes back to about 384.50. But I would say there's a decent chance that SPY is going to stay above that 384 level. I think the sell-off overnight, again, was a bit overdone this morning. So that's the trade that I would take on. But like I said, can't make any new trades today. Robinhood locked me up. I'm in jail currently. But this put debit spread that I have for Adobe, pretty much toast. Currently going for $11. $11 is lunch money, so I guess I'll try to close it at least. For something like $10, if I had to guess, might go for. Oh, I actually have two of these. That makes a difference. Damn it, Vlad, let my boy. Yeah, let me out, please. It's really funny, though. Like, if you call them up, and you can call them up and you can ask them to, like, take away PDT rule, and you can do that multiple times. But this one, you can't do anything about, since it was an early assignment, which is really freaking annoying. But I'm going to see, what the hell, 4, 5, 7, 6, 88. Hopefully that's the right one. Nope. 4, 6, 8, 3, 2, 7. Please log me in. All right, gonna close these. There we go. We got them at 22. That's surprising. We got them at 11 each. So we saved ourselves a couple lunches. Odds of Adobe coming all the way back down to 335 at this point, especially with my assumption on SPY being oversold in the pre-market, pretty low. So that one ended up taking the L for it, but that's okay. Kind of wish I had taken profits on it yesterday before the bell rang. I was up like 150, but I felt like it wasn't enough. It wasn't worth the risk that I had put on. So decided to hold that bad boy into expiration, and Adobe decided to slap me across the face. So here we go. So closing options alerts. Premium, one-on-one, freemium. Just cut losses on the Adobe put debit spread. That one expires today, 12/16. So this is where it helps if you have an extra week until expiration date. But I decided to be degenerate and play the weekly options. So that's what I get for not sticking to my rules, I guess. But yeah. Originally I opened those at, let's see, put debit. Did you buy or sell that call on SPY? So I'll explain the strategy that I use. Let me just finish this up right quick, and we'll talk about that strategy. 335, 330, Adobe put debit spread. I bought them at 212 each. Opened at 212 each. They closed at 11. So 212 minus 11. 201 times 2. A $402 loss. I would have been a lot happier if it was a $420 loss instead of 402, but it is what it is. Alright. Now it's coming back down to 346. Yeah, so the one that I was assigned on, we'll talk about that. That was for SPY. And I'll show you which one I got assigned on. So this was an iron butterfly that I had set up a very long time ago, actually. And I will go to the Discord and pull up the history for that. But basically my assumption was that SPY would be anywhere between $325 at the lowest point and $385 at the highest point on my expiration date, which was set for today. And obviously right now we're trading at $385. So what I did, SPY iron butterfly. I've made a few iron butterflies recently, so we'll have to sort through and find the right one. This one right here. So if you look at the confirmation, hopefully I posted the confirmation. Yeah. So I ended up buying 2 365 calls. I sold 2 345 calls. I bought 2 325 calls, and then I sold 2 $345 puts. So this is an iron butterfly setup where you sell the strike price that you think the stock is going to be pinned at, right? And then you buy strike prices based on how much money you want to put up. So I put up $2,000 of collateral. I ended up getting $1,700 total, or no, $2,000 of collateral. I ended up getting like $3,600 total credit. So $4,000 collateral, $3,600 credit. My risk was around $400. And today, the expiration date came around, and SPY obviously is a lot higher than the $365 strike price. Right now, it's trading at $385 or whatever. Right? So since, like, we can look at that option and see what it's valued at right now. Let's go to SPY. We'll scroll all the way down to the 365 that's expiring for today. So this option is going for $2,085 or $2,075. Can't freaking speak today. So right now, SPY itself is trading at 385. We'll call it 385.5 just for easy number's sake. And then I had the 365 strike price, so we subtract that. So this option should have around $20.50 of intrinsic value. So that's just the difference between the strike price and the current market value of the stock. If the option is in the money and the total value of the stock is $20.90. So that means that there is 40 cents of extrinsic value, or time value, basically, time and volatility value, that's still left in this option. So, based on, 30 divided by a total value of almost 2,100, that means there's only 1.4% of intrinsic value or extrinsic value left in this option. So very minimal, basically, extrinsic value. So the person that bought this option decided that it was worth just exercising the 365 call that I had sold to them. So they bought the 100 shares at the $365 strike price, which means that I had to sell them those 100 shares at the 365 strike price. Now, this would have been a problem if this just was a regular cover call where it just sold a 365 strike price. But for me, I ended up buying a $345 call in the Iron Butterfly that I had set up. So that means that I agreed to buy 100 shares at the 345 strike price. And then with that 385 call that I sold, I agreed to sell those same 100 shares at the 385 strike price. All right. So since I had that 345 call, that saved my ass, basically. Now, if this was just a regular cover call, obviously, I would be taking a unrealized loss, or what you would call an opportunity cost. I could have sold the shares at 385, but I decided to sell them at 365. But that's just with a regular cover call. This was an Iron Butterfly. So since it was a spread option, I was able to exercise the 345 call to buy my 100 shares to sell them the 365, or to sell them their 100 shares at 365. Hopefully that makes sense. I know that it's a little bit complicated. I've made a couple videos on it in the past, so if you ever get exercise, watch this video. It should help you out. This one's one of the short videos that I have. I don't want to play it, but it's like a 45-second video. It just shows you exactly how to fix the issue very quickly. I have this one also. I got like Pokemon cards on exercising options, basically. And I think there's a third video that you can watch, why you shouldn't exercise options, but that's besides the point, but still a useful video, I'd say. Dude, look how round my face looks there. Oh man, it's always fun looking back on my past videos. So it's due to the buyer, not the broker. Yes, correct. It's the buyer that decided to exercise the option, not the broker. The broker exercised the option that I bought on my behalf. So I was able to exercise the 345 call automatically because Robinhood and the risk management team exercised it for me. But the 385 call that I sold, the buyer ended up exercising that. But let's see. What else is going on? Hopefully that TLT trade is going well for us. We're only up $130. These are still going for 18 cents a piece. Jesus Christ. What is going on with TLT? It's trading at 107. What strike prices do we choose? I feel like it thinks that we have the 108 strike price. This is short. I might even open... Well, I can't open more of these, can I? Yeah, because I have the deficit. Screw you, Robinhood. Okay, I'm just going to hold this into expiration. The odds of TLT making its way all the way back up to 109, I think it's incredibly freaking low. I have an unexercised skew call. 480 or 48. Yeah. Um, let's see. Skew currently trading at 49, so it's doing pretty well right now. Go figure whenever the markets are selling off. What do you recommend to avoid being assigned? Close out of your options before they become super deep in the money. Like, I had no real reason to hold that option past like Wednesday or Thursday, really. I knew that it wouldn't, I knew SPY wouldn't fall from 400 to 360 after Fed Chair Powell came out and spoke. But I decided to keep it anyway because I didn't want to close it. I was too lazy to close it, basically. So you can just close it a couple days before expiration. That should help you out a little bit. But yeah, if you get assigned early, it's not that big of a deal. The biggest issue is just not being able to trade for the day. The buyers are asleep for skew. Yeah, they might. No, it looks like it might drop back down to 48. I don't know. Currently trading at 48.50, so it's not too far from the strike price. So that means since it's closer to the strike price, it's going to have more extrinsic value. So extrinsic value works like a bell curve to where if the strike price is right at the current stock value or if it's at the money, it's going to have the greatest amount of extrinsic value. And then as it goes super deep in the money, like my 365 call, then it's going to have almost no extrinsic value. And then if it's super deep out of the money, obviously it's going to hardly have any value at all. But yeah, it looks like that 384 put credit spread would have worked like a charm. Of course, on the day that I can't open it. It's okay. We missed some opportunities here and there, but still got to make our profits later on. Now let's check out UVixie, because I do have some shares of UVixie that I'm considering selling, and I guess I'm probably going to hold them. I think that recession fears are probably just going to get worse and amplified. And if you look at the VIX is cyclical. So if we look at the 1 year chart, I have these cycles. This would actually, I would think, counts as one cycle, so we'll get rid of this. But we have these cycles every... looks like 1, 2, 3, 4 months. 1, 2, 2 months. 1, 2, 3 months. 1, 2, 3, 3.5 months. So likelihood is this one is probably going to last anywhere between 2 and 4 months. The new narrative is probably going to be recession. And I think that volatility is going to go a lot higher. The problem with UVixie, though, is that even if it goes a lot higher, even if the VIX goes a lot higher, it doesn't necessarily mean that you're going to make that much more money, because with UVixie, it's 1.5 leveraged. So let's see. It looks like this would be the start of the cycle. It went from $9 all the way up to $13. This looked like a start of a cycle right here. From 11 all the way up to 19. This was a cycle right here. Started at, looks like $11, went all the way up to 22. That one doubled. That's crazy. But basically, the VIX has been very cyclical, 2 to 4 month cycles. And it typically, at least for this year, has traded between $20 and a high of $35. So I would probably want to take profits once the VIX hits maybe. I would be a little bit conservative, maybe at like 27. So we'll discount it by about 10%. So I'm gonna set an alert for if the VIX goes above the 27 price level, then I'm gonna sell my UVixie shares, which is. I originally bought these shares whenever VIX was trading I want to say around $20 a piece. UVixie itself was like 780 is what I bought the shares for, and I might. I can't. I can't even buy shares. This is garbage. Ugh. I think I might just head over to my Fidelity account and buy some UVixie shares there. Um, let's see. I don't care about your Roth IRA. Screw off, Robinhood. They're advertising their Roth IRA like no other. Let's see. Wait a minute. These I could just let expire, since they're super deep in the money, since they're put options way below the current stock value. Don't have to worry about those. Or super deep out of the money, I'm sorry. And then the USO calls, those are expiring today. They have zero value, so don't really care too much. Fulgent call debit spreads are expiring in January. Those are at max loss too. The leaps options that debit leaps options that I had bought in the beginning of the year, whenever I thought the stock market would be bullish, but obviously things have turned around. The gold leaps that I have is almost break even. I'm only down 200. Map sleep, another one that I bought when I thought there was going to be a bear market or a bull market. And this Bank of America $37 put option is actually finally up $144. I ended up paying $768 for 3 of them, so I invested about $2,300. And I was thinking that Bank of America would be going to a new low, and they're pretty close to it. They're at 32 right now. Versus the yearly low at 29. So I'll be interested to see how Bank of America does on their next earnings report, given that the demand for vehicles, homes, and pretty much any big assets that they make a lot of money on thanks to the high interest rates, the demand for those items has slowed down pretty dramatically. So I think Bank of America is going to have a pretty crappy earnings report come January of 2023, especially given, the recession fears that are going on in the market. It might even sell off before then, with the rest of the market. So we'll see. But I'm holding that Bank of America leaps put for right now. And I'm going to head over to the Fidelity account. I'm going to buy a few things, actually. So I want to buy... I'm going to be buying shares. It's not going to be options, unfortunately, because Fidelity doesn't allow me to trade level 3. These have been around for a very long time. Bank of America Gold, I opened those over the last couple of months. Maps and Fulgent, I opened at the beginning of the year. I would say anywhere between it'll vary depending on the account size, I guess, but usually between 3 and maybe 8 swing trades at a time, Aaron. But let's see. Yeah, between 3 and 8 swing trades that I'll keep open. That TLT is coming back down, looks like, down to 16. I'm just going to hold that one. I'm pretty confident in that trade working out. But let me log into the Fidelity. We're going to buy some UVixie shares. And we're going to buy also some QQQX shares. Actually, you know what? I'm not going to buy UVixie in this account, just because I don't want to have to transfer and That'll be a mess. But I'm going to buy some QQX since that is my plan to dollar cost average into this basically a dividend fund. It's a cover call fund that ends up paying you about 8% yearly. I'm investing about $200 a week into it, which is 0.5% of my cash pile, and then I'm buying 100 shares, or not 100 shares, Jesus Christ. I wish I had that kind of money. $100 of Fulgent, Genetics, FLGT, and Tesla, TSLA, once a week. So spending about $400 a week, dollar cost averaging, which is a total of 1% of my current cash balance. So that'll last me about 100 weeks. Why is it not doing my damn order? It should just default to a market order if you don't select it, but okay. Fidelity likes to make things a lot harder than they should be. Who would have thought? I do like Fidelity in their trade prices, though. They usually give some of the best prices for options, so can't really knock them for that. But let me post this over in the alerts, buy alerts. So another $200 of QQQX. Just bought 200 QQQX. And then premium. 101 premium. Carrying out my plan to dollar cost average 200 a week in this stock. So now I want to see how much total I have. I don't even know. I think it's been 3 weeks since I started this plan, so I should have about $600 worth. Rollover IRA. No, I just want to log into my dang account, please. And let's see. Positions. So this is where I keep most of my Tesla shares, 35 Tesla shares. So now 27 shares of QQQX, and then a measly 20 shares, kind of a placeholder for MAPS, currently trading at $1 each, which is ridiculous compared to where it was trading when I started buying it. I bought a penny stock before it was a penny stock. Weird flex, but okay. I bought it when I was trading at like 20. It was like a new SPAC stock, and they were actually a really good company. The problem is just their management. It's been awful in not only affirming shareholders, but like retaining talent. It's been very brutal. But currently trading at $1. My dumbass ended up buying it at an average price of like 12. So obviously not a great investment. Now, I would say if they can turn profitable like they were supposed to be, so this is a company that pitched themselves as being profitable since their inception in 2012. Weedmaps Technology, if you don't know the company. They pitched themselves as being profitable since 2012, but it seems like as soon as they went public, they started posting losses, negative 17 cents. They did have a couple positive quarters, then negative 19 cents, 13 cents, and negative 6 cents. So can't always trust the suits that are running this company. And it's funny because the suit that was running this company was actually a lawyer. But it is what it is. Let's see. CRKN. I haven't heard of that one. Crown Electro Corporation. Jesus Christ. It started at $10. This looks like a biopharma. Is this a biotech? It's got to be a biotech, as much as that moved. Crown Electrokinetics Company. I have no idea what the hell that would be. That's wild. But let's see. I would buy some more Fulgent Genetics, but since Robinhood's not letting me buy anything, I can't do that. So I'll have to buy $100 on Monday once Robinhood unfreezes my account. So I ended up starting to buy this stock when it was trading at like around 80. Obviously, I've dollar cost average down to 50. Currently trading at 30. So this is actually a very solid company in terms of their free cash flow positive. It's one of the few free cash flow positive genetic testing companies. So that's what really stands out to me, is that it's, you know, a decent investment in a sea of really bad. Like if you look at PacBio, if you look at Invitae and their free cash flows, super negative. They spend way too much money. Basically their CFOs are like drunk sailors, whereas a CFO for Fulgent Genetics actually seems to have at least a little bit of a brain. But yeah, it's currently trading at 31. I think that it's super discounted. Given that genetic testing is likely to be more prevalent in the future to personalized medicine, and Fulgent Genetics is kind of a one-stop shop almost for genetic testing. So they have like their own sort of tests that they do that doctors can, you know, apply to get for their patients. Yeah, you can actually check out the details on the site on their website, but they've made a couple acquisitions that have been, I think, pretty useful recently. Their main thing was COVID testing. Over the last couple of years, they made a shit ton of money on COVID testing. Obviously, that is going away. Thank you, Biden, for getting rid of COVID. He just wished it away, and now it's gone, right? But yeah, they have helio liver tests. Let's see if there's Parkinson's and Alzheimer's panels. So basically, they just do genetic testing. And they're like a one-stop shop for clinicians to go to in order to order their patients genetic testing. So anyway, whereas PacBio and Invitae, they provide the technologies, whereas Fulgent provides the actual test. So they're kind of the direct-to-consumer DTC versus versus Invitae is the one that creates like the technology for it. Anyway, let's head on over to the charts. Looks like SPY actually did end up coming back down to that 384 level, so interesting enough, that put credit spread I would have opened isn't doing so hot now. I would have closed if it hit like 384.50 was my plan, so if y'all did end up opening that, I hope y'all closed it whenever it hit around that level. Now it seems like it's breaking back down. TLT is still trading at 106. Meanwhile, the stupid freaking call credit spreads are so expensive at 15. So if you haven't opened this, I think that it's a decent idea. They're going for 15 cents a piece. I think that's outrageous. What is that? Oh, we have next week's expiration date, 12/23. That makes a lot more sense. Yeah, if it was today's expiration date, these would be going for nothing. But yeah, since we have that extra week, it doesn't help our case. But, let's see if we can find any opportunities. Oil is dropping more. So oil generally goes down during recessions, like especially in '08, the great financial crisis. The price of oil plummeted. Obviously, it went up a crap ton ahead of it, ahead of '08, and I guess it kind of just went up for the better part of 7 years after 9/11, right? Went up for the better part of the 7 years, and then once we had the recession, it ended up collapsing, giving up basically all of oil's gains from 2004 to 2008, which is interesting because that's around the same time that they were increasing interest rates. And then the fall of oil is the fall of overall demand in the economy, right? So whenever people aren't ordering as many goods, you don't need as much oil in order to ship those goods around because people just aren't buying as much shit. Oil also plays a large role in plastics, especially, which obviously very popular, especially here in the U.S. Oil plays a large role in plastics, and whenever people start getting laid off, they're not traveling to work, they're not going on business trips anymore, using jet fuel, so obviously the demand for oil overall just ends up collapsing. It's Friday, aka market maker's favorite day to screw everyone. That is certainly true, because Fridays are always the most popular expiration day, and it is the third week, I think. Let's see. I think it's the third week of the month. Let's see my calendar. Go to the monthly. Yep, today is the third Friday, so especially the case for today, with it being the third Friday. So this is the monthly expiration day every third Friday. That'll always have the most open interest. That'll always have the most volume. Just because monthly options have been around a lot longer than weekly options, and especially the brand new daily options. So with that going on today, we do have market makers pulling their strings and sending the markets every single direction. So basically what they're going to try to do, swing the markets in both directions, so both people with call options and both people with put options end up losing their money, end up losing their shirts. So I would say usually on Fridays go lighter with your trades if you have a Friday expiration. But yeah, definitely making some crazy swings. We swung up like 0.5%, 384 all the way up to 387 almost, and then back down to where we started, below where we started. So a very wild day. We just had PMI come out, so that's probably what's moving the market right now. Started at 9:45, which is exactly when the sell-off started. So services PMI, let's go to the economic calendar. I totally miss this bad boy, but I always love talking about macroeconomics. So manufacturing PMI and services PMI came out today, and the S&P Global Composite PMI came out. Do I get up at 5:30 in the morning? I actually get up at 3:30 in the morning, recently at least. No, 3 in the morning. So I've got a daughter on the way, and my daughter loves to kick my wife's stomach and wake her up. So when the daughter wakes up, my wife wakes up, and I wake up at 3 in the morning. Fun stuff. Hopefully she doesn't have the same sleep schedule whenever she's born in a couple months. But, yeah. Enough on my personal life. PMI is coming out, or already came out, 46.3 46.2 versus 47.7 expected. That's a pretty decent miss. Usually anything more than about half a point is like decent, up or down. So what PMI is the producer manager index, I think. Let me just double check the verbiage. Purchasing manager index. So basically, this is a survey that they do that measures the level of purchasing managers in the manufacturing sector and then in the services sector. So it's kind of a survey of, I guess, how do you think the economy is going right now? Sort of. A reading above 50 is good. That means that they perceive the economy to be going well. And then a reading below 50 is bad. So right now it's coming in at 46. So that's pretty significantly almost 5% below 50. Or, sorry, almost 10% below 50. And then the services PMI is especially bad at 44.4 versus 46.8 expected. No sleep till Brooklyn. Congrats. Thank you. Very excited for my daughter to come along. Quad witching. So quad witching, yeah, it might actually be. So it's January, March. Wait. Yeah, January, March, June. No. March, June. Every 3 months. So March, June, September, and then December. So this would be the last expiration date, which is also the end of year expiration date. So maybe it's a quintuple witching. No. Yeah, it is a quad witching day. So definitely expect some volatility going on in the market. I guess I should have made a video about quad witching, but I didn't realize that we were coming up on the last third Friday. So maybe I'll make that for March. All right. Well, yeah, markets are coming back down to 382 now, so we might just get a new daily low out of this. If the market makers really want to push it and get rid of all the calls that people probably bought whenever the markets were going up right ahead of the CPI, or not the CPI, the PMI. Those are getting absolutely murdered right now. Dropping from 387 all the way to 383 in a matter of 6 minutes. Rough. That's 1% in 6 minutes. That is very choppy market. Let's see. TNX currently trading up today. So the yields are going up. So I think the bond market might be finally catching on to the fact that the Fed isn't lying. Interesting enough, the 10-year Treasury yield is up. I want to see how inverted the 210 is. So let's go over to the Analyze tab. Yeah, it'll go to the moon at 3 p.m. Yeah, you got to get rid of the puts too. So eventually they'll probably swing to the upside wildly and try to destroy all the people that bought the puts. Let's see. You got to know the name of the game. You got to outsmart the market makers. Obviously very hard to do. But let me pull up the Analyze tab, go to Economic Data. Sorry, I sound stuffy as hell right now. Where is interest rates? We're going to go to, I guess the 210 is probably getting even worse if people are expecting a recession now. So I'll explain this a little bit. If I can find it. Let's see. Prime bank loans, Treasury. We're looking for spreads. There we go. Interest rate spreads. And then the 210 is the most common. And this is deep. Jesus Christ. It's all the way down at negative 0.8. So that means that the difference, let me try to pull up the longer time frame. I hate that you can't zoom out of this. Okay, well, screw you, Thinkorswim. So basically what this means is people think that it's more risky over the next 2 years is more risky than the next 10 years. So since they're taking on extra risk, they want to be paid a higher yield, right? So people are avoiding buying 2-year bonds. So the demand for the 2-year bond is very low, which means that the price of a 2-year bond is extremely low, which means that the yield, so basically the APR, if you want to put it in like bank terms, is higher. So since there's a smaller pool of people to pay out, those people get more return for buying those 2-year bonds because people are afraid to buy the 2-year versus the 10-year is more safe because, eventually the economy evens out. You're not going to be in a recession for 10 years, God forbid, unless we have another great recession, which also likely. But yeah, so that's the 210. Right now it's at negative 0.8, and the last time we saw it this low, I'm trying to see if I can pull up the longer term history. The last time we saw it this low was way back in 1982. That is crazy. Wow. And pretty much every time that the yield curve has gone below 0, which would be, we can draw the market 0, hopefully. Well, I don't think we can add any drawings to this chart. That's so dumb. Like, why can't I do that? Maybe if I copy and paste this into the charts? No, can't do that. But basically, anytime that it goes below 0, we've had a recession. Doesn't necessarily mean that it's going to happen again, but the likelihood of a recession at this point is incredibly high, and this is something that I wrote about in the morning market update. I have some option call Tesla calls and QQQ. Is it risky? Depends on the expiration date for them. So if you have a leaps option, I would say yes. So if you have like a year expiration date, I would think that would be pretty risky, and I'm making a video for Sunday talking about a few strategies that I wouldn't use in the current market just because they use a lot of capital. So any strategy that uses a lot of your cash, you should generally avoid, because cash is the best thing that you can have whenever we're going into a recession. That means that you have a little bit of a cushion, basically. It expires January 20th, 2023. So you have about a month until expiration. I think over the next couple weeks, you're probably going to have a rough time with those call options, although Tesla already did fall, significantly. I think it ended up recovering a little bit this morning, and now it's selling off the rest of the market. But yeah, I think there's going to be increasing recession fears over the next couple of weeks. So short-term calls, I would say, still are somewhat risky, obviously. With the high volatility that we're getting right now, they could make some money over the next couple of weeks. But I would say try to get out of them sooner rather than later, because especially in the last, 30 days of that option, you're going to start losing time value. Even if the stock market ends up trading flat, which is very unlikely, you're just going to lose money from the time value for that option. So, yeah. Tesla is trading at 153 right now. That's pretty low and pretty close to Chicken Genius Singapore's price target at 140. I was actually kind of believing him whenever it was trading at 250. I thought that there was a decent chance that we visit 140, and we're getting pretty damn close to it. So Chicken Genius Singapore hit the nail on the head with that one. What else is going on, though? The VIX is trading at 23, so we're headed up now for the VIX. That's good. Up 1.1%. Let's see what UVIXI is up by. UVIXI is supposed to do 1.5 times, so today it's up 3%. I don't know why UVIXI and VIX don't trade like they're supposed to. Usually, UVIXI is supposed to be 1.5 leverage, so whatever VIX does is supposed to do 1.5 times, but it's always off for some reason. I'm from Singapore, same as Chicken Genius. Yeah, I've got a few people on here from Singapore, interesting enough. It's a lot of, what do you call somebody from Singapore? Is it Singaporean? When the market started this year, nobody believed that the market would nosedive. I'm not the guy that missing that opportunity. Again, puts for the wins, guys. Yeah. Definitely. I think there's a lot of people still believing, in the Fed pivot, especially on Twitter. People are just pissed off on Twitter about the Fed continuing to raise interest rates. And I've said my piece on it over on Twitter a couple times. My most recent tweet on the Fed is everyone says don't fight the Fed until their portfolio drops 20%. And the thing is, we need the Fed to keep raising interest rates. Otherwise, if they don't, that inflation gets entrenched into the economy. Then you end up like countries like Argentina, who have, like 80% year-over-year inflation. And it's a threat to democracy. Basically, when you put more people into poverty by letting inflation get out of hand, the people that get put into poverty feel like they've been wronged, rightfully so, and they rise up against the government. So it's a good idea for the Fed to stop inflation while it's while they can. It's a necessary evil to induce a recession. And this is something that I talked about, too, in the premium Discord that I was getting to. In the morning market update, I basically said the same thing, a little bit more detail, I think. But recessions don't necessarily mean the stocks sell off. No, this is what I needed. The Fed is likely to induce a recession in 2023 with their higher interest rates going to 5.1 to 5.4 target rate by the end of the year, which is necessary evil to get rid of inflation. The cycle of inflation is inflation, stagflation, recession, right? So it goes from inflation to stagflation, which is both inflation and a slowing economy, or a stagflating economy, to recession. Right, this is something that I learned from Maverick of Wall Street, who's been around this for a lot longer than I have. But since prices are products of supply and demand, and our supply chains aren't getting any better, we need to destroy demand, or in other words, induce a recession. Recessions don't necessarily mean that stocks will sell off, but given the massive valuations that companies have been given, thanks to the incredible stimulus over the last couple of years, it's very likely that stocks are going to continue to sell off. Now, my price targets for SPY is $350 for next year, so down another about 10%. $320, I think, is the worst case, which is the start of the right before COVID, the $320 price level. And then over the next probably 3 years, if the recession continues and companies are earning less and less money, and the Fed keeps their promise to keep interest rates at 2.5 to 3%, then that means that stocks that did well when interest rates were zero aren't going to be doing so well anymore. Their growth is going to slow down. which overall means that their stock prices are going to fall. And I think worst case scenario for SPY over the next few years is between $240 and $290, which is where it was back in 2018. Tesla is kind of a buy for me here, but I would rather sell puts on it as well as Google. I'm not interested in selling puts. So this is a strategy that I'm avoiding just because of how much capital it uses. So it uses a shit ton of cash, especially for, I guess Tesla's become a lot cheaper than it was. It only costs you $10,000. So yeah, if you have enough ample cash for it, if like you have, say, $100,000 portfolio to where $10,000 of cash is only 10% of your portfolio, I would say that's fine. But if you have a smaller account like me, obviously that would be like 30% of my cash. So not exactly an affordable strategy for me, but there is ways to get around that with credit spreads and stuff like that. But you don't get to own the shares if you get assigned on the put. So that's kind of the drawback, but also the good thing of the put credit spread. Payout of 8% per year. I got assigned early on the calls for the Iron Butterfly. Yeah, me too. Yeah, so Robinhood won't let us open new trades for the day. How far in the money? Oh, shit. No, I responded to the wrong one. Damn it. Yeah. Super deep in the money. Anyway, so it's 10:30. Can't really make any trades today. But let me check out Robinhood, see if we might be able to close the TLT iron or call credit spread. See what the value for that is right now. It's going for 18 cents a piece. I still think TLT is going to keep coming down. I think that the bond market is lying to itself if it thinks that the Fed is lying. So I'm going to keep hold of these. And I will catch y'all Monday at 9:30 in the morning. Make sure to hit the like button on the way out. We got 38 viewers and 17 likes. So get those likes up, and I'll catch you on Monday. See you, everybody.